Welcome to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Hey, good morning, everyone, and welcome to the next episode of Financially Fluent. Today, we'll be talking about annuities because it's Annuity Awareness Month on this recording date of June the 16th. This is not a recommendation or an endorsement to purchase one, but we do want to continue our educational theme. Feel free to share this episode to a friend of yours that may have questions about annuities. Be happy to do that. But we are going to get into different types of annuities, even some trends that are happening. I think on any episode, we try to talk about trends, whether that's real estate or other types of investments. And we're going to welcome Cindi from our team to the show. Hey, Cindi, how was your week last week?
It was a very busy week. With you on vacation, it was a lot busier than I thought it was going to be. Had a lot of work to do. So I hope you had a nice, relaxing week off and had a good time on your vacation.
Yeah, it was kind of overdue. My wife and I have always talked about going to New England, and we finally did it. And so we got to go to Boston and Newport, as well as Nantucket Island, and it was pretty fantastic.
Good weather?
Interesting, being from the South, once you get to about April, you're out in shorts all the time. So didn't wear a whole lot of shorts during the trip, a couple of days, but it was just fantastic, all the history. And so we did not luck out in Newport, unfortunately, but it was kind of overcast and rainy. But so we'll have to go back there. But the days we're on the island, I don't think I've ever been outside at the beach with 68-degree weather and not be cold. It was quite nice. So
Good.
Overall, just a fantastic trip. Yeah, good times. I'm ready to rock and roll this week back at work.
Hey, so are we going to start off with some trivia before we get into all the fun stuff?
I think we should. Yeah, why not? Let's get into some trivia. I know last time you thought you had me stumped on a sports question, so I'm sure you're not going to go back to the sports arena today.
Nope. I chose the New England to kind of go in the theme of your vacation, and
All right.
I actually have a couple of trivia questions because I'm going to get you on this one.
Okay.
So I'm going to try. Ready to go?
I'm ready.
All right.
Ready as I can be.
Okay. So I think I have a couple here, but I think this is a good one. Which New England state is known as the Ocean State?
Ooh. Well, full disclosure, I didn't hear this answer, but I did hear somebody say that Rhode Island is mostly water, so I'm going to go with Rhode Island.
You got it right.
All right. But you said there was a couple. Is there a second one you have to try to stump me again?
Okay, let me think here. Let's see. That one's going to be too easy, so because you got that one right. Okay. Here's a good one. What small New England town is known for hosting the longest continuously running 4th of July parade in the United States?
Oh, boy. Yeah, that I really wouldn't know.
I can give you some choices.
No. It's okay if I miss one, right? I feel like it's probably a small town in Massachusetts, but I'm just going to say Boston.
Wrong. Bristol, Rhode Island.
Still in Rhode Island. Okay.
Yeah.
Oh, okay. Awesome. Well, that is really cool. I tell you what, that was great. Thanks for doing that. Let's get into the meat of today's discussion.
Yes, let's do it.
Yeah, so we're going to talk about annuities. It is what they call Annuity Awareness Month. I think by the time this gets released, it may technically be July the 1st, but it'll still have relevance throughout the year, right?
Right.
So sometimes, wait, you're going to say something?
Well, I was going to ask, just kind of like the general definition of an annuity before we kind of jump in too much.
Right. So you can look up a textbook definition, but essentially the way I look at it is you're giving the insurance company your money in exchange for kind of a contractual agreement on a benefit. So the most common one that people think of or how it originated is, hey, I give the insurance company a lump sum of money and they're going to pay me back, payments for the rest of my life, right? That would be just one example. I like to really break them down into four main types of annuities. So I'm hoping that's what we talk about today. The first one is kind of what I just mentioned, the acronym, because I can't think of a single episode this year that we won't introduce an acronym in this industry, but SPIA, which stands for Single Premium Immediate Annuity. That's where, like I said earlier, you're giving the insurance company a lump sum of money, and then they're going to make payments back to the annuitant as an income stream for life. So there are several different options there, but the most simplest form would be, hey, let me give you a couple $100,000. Now you're going to pay me back a monthly stream of income, similar to what somebody might be used to with a paycheck or, a pension, even Social Security. So it might work like that. Now, if it's a life-only annuity, there's a lot of different ones in there, but it could be that they pass away and then the money just kind of poof disappears. But oftentimes people might pick one where it pays out for a certain amount of time, at least for 10 years, 15 years, something like that, to a beneficiary should they kind of pass on early. So that's one of them.
Okay.
That I would
What's
find.
Another one?
Yeah, so another one's going to be a fixed annuity, or sometimes known as a MYGA.
Okay.
Multi-year guaranteed annuity. And so oftentimes when people are retired, they might want to have some money that is getting that guaranteed growth or guaranteed interest. And so some people think of a CD in that vein, right? And so with the MYGA, you might get a higher rate, you may not, than versus say a CD. They do not have fees, right? And the principal is fully protected by the insurance company. So, you do want to make sure that the insurance company has got a good credit rating if they're going to hold it for a long time. I will say with MYGAs, some of them give you 10% liquidity, just meaning, let's say you had $100,000 in it and you're in year 3 of a 5-year contract and you wanted to take out up to 10% of that account, you could. I wouldn't say that'd be the main reason to get one at all, but sometimes that makes people feel a little better. So there are differences on why one company might offer you a higher rate than the other. And so I think it's important that whoever you're getting it from kind of explains, why is one paying a higher rate than the other. It could be because of their credit rating, could be because you're giving them a bigger lump sum. But for example, some of them, if you give them $100,000 or $250,000 versus, $50,000 or $20,000, they may pay you a higher rate based upon how much are you starting with. Also, in the liquidity feature, there are some that may have no liquidity, but they give you a higher rate. So maybe, you think about doing that.
Okay. What's another annuity example with full downside principal protection?
Right. So another one would be a fixed indexed annuity, also known as a SPIA. Okay. So that's going to give you full downside protection, meaning whatever principal you put into it, just like in the MYGA, cannot go down in value. So there's a phrase that I think is overused, but it's called zero is your hero, which just means that the stock market goes down, you won't lose money, you get a zero credit on some of the contracts. So essentially, the fixed index annuity is trying to tap into an index. Could be the most common one would be the S&P 500. So for example, if the S&P went up 1 year 20%, maybe you get a 10% credit. Or in a lower interest rate environment, because I will say these fixed annuities, the benefits that you get are kind of indirectly based upon interest rates, right? So at higher interest rate environments, you might be able to get higher cap rates. Lower interest rate environments, you may see lower caps. I can remember these a few years back, the cap rate might be like 2.3%. So that's not as attractive as something higher. Another thing to think about with these FIAs are that they have a surrender schedule. So if you're in a 10-year FIA, that just means for 10 years, there's a surrender schedule on that one. So let's just say you're 2 years into it, you gave them $200,000 and something dramatically changed in your life and you want all that money back, you don't want to do it anymore. Well, there's going to be a fee associated with that to surrender it. So that's really important. Let's just say it's an 8% fee to get your money back. So now you're not getting the 2% back, right? You might get $200,000 plus any interests that were credited in the first year or two minus the surrender fee. So it doesn't mean that you don't do them, but I will say how important it is from a planning perspective. When you're getting anything like this, make sure it's doing what you want it to do. So for example, let's say you had a 7-year surrender schedule you're in a fixed index annuity and your goal was to grow it right? Maybe in your investment accounts, because you have this, maybe you're allowed to be more aggressive in your investment accounts, right? This as a kind of a bucket of money that's not going to go down in value. So in that scenario, just make sure it's the right amount, that you're hopefully not going to have to touch it during that surrender period to be able to give you the most that you can. But at the end of the surrender period, you got a lot of options. You could exchange it into a different one. You could put it into a managed account. You could have lots of choices. I do want to point out that the fixed annuity, so that's the FIA as well as the MYGA and the SPIA, right? Those you do not have to be a registered agent or a rep with FINRA to quote sell these fixed products. So they're basically regulated by the states, not by the SEC. So it's just something to kind of be aware of. So I think there are a lot of dinners I've seen out there that try to just, I would say, promote these, that everybody needs them with all your money. And that's just not true. It's appropriate for some people with some of their money some of the time, right? So there's different ways to quote skin the cat. So this may not be what's best for you. It's really one of those it depends situations. So just keep that in mind. And on that note, someone that is fully licensed to sell securities and all types of investments, of course, they can provide these as well. It doesn't mean they shouldn't. Their RIA or broker-dealer may have a higher amount of paperwork to justify why is somebody doing this. They certainly could provide this. I'll say something else too about the FIA. So let's say what happens is, the S&P goes up 3%, maybe you get a 3% credit that year. S&P goes up 12%, maybe you get 8% credit that year. So these caps that are tied to the S&P 500, some of the annuities in this space will give you a cap that's good for the entire length of the contract, from the first year to the 7th year or 5th year. Other ones may have an introductory rate, if you will. Hey, we're going to give you a cap of 11% in year 1, but then in year 2, that rate might change. In year 3, it might change. So it's just important to understand, how do these cap rates, is it locked in for the entire contract, or could it change over time? So it doesn't mean that one's better than the other, but it's really important to understand that. And they all will give you what's called a fixed rate option. So maybe some of it is tied to the S&P, but maybe you have some of it tied to a fixed rate of 3% or 3.5%, something like that. And then I mentioned it didn't have a fee to it. That's without a rider. Well, what if it has an income rider? Well, that rider might have a fee. Then that just means you might be able to turn this on to an income for life kind of play. And so when it does that, that rider will have a fee. You just want to make sure that it's worth it.
And now, a quick message from today's sponsor. If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
Okay, what are some other annuities that act more like an investment?
Yeah, so a newer one has an acronym RILA, which stands for Registered Indexed Linked Annuities. So this is, I would say, one of the newer ones that's trending, if you will. And so how do those work? They have a limited downside loss provision. And there's a lot of different companies out there offering them now. It's very competitive space. So it's similar to a FIA where they have caps, but in this case, you're going to have a cap that's much higher than a FIA, but you could lose your principal. So it's important to understand that. And so to kind of give you an example of one, let's just say you had $100,000, you put it into a RILA, all right, and then 6 years later, I'm trying to keep it as simple as possible. 6 years later, how did the S&P 500 perform, right? And so let's just say it went up 60% over that period of time, and you would get, in a lot of cases, 60% credit. So now your value at the end of that 6 years would be $160,000. And you also have some downside protection. So let's just say in this example, you had very bad timing and you had 15% downside protection. And the market, the S&P, from year 0 to year 6 was down 13%. Right? Just really bad timing. In that case, because of the 15% downside buffer, you didn't lose any money, right? It's going to take your inside of the 15% protection. So they're going to true you up at 0. So at the end of the 6-year period in this example, you would actually still have your $100,000. You wouldn't have lost any value. You wouldn't have lost the 13%. But let's just say in this example, you chose the 10% buffer. So in that example where the market went down 13%, you take 13 minus the 10, you would lose 3% of your money. Still not great. As a matter of fact, if you had a time machine, you'd say, I think that MYGA sounds really good right now. I'd like to get my 5% per year every year. But that's kind of how it works. But what's happened is because it's such a competitive space with annuities right now, because a lot of them don't have a fee coming out of the account. So that is, I will say, attraction for some people that do purchase these is there's no fee coming out of the account. Because it's so competitive, what's happened is this thing has really evolved. What used to be really simple, hey, I put money in, now, and 6 years later, you tell me what I got. Now you can be in different indexes. So you could be tied to the international index. You could be tied to a social index. You could be tied to the small cap, the NASDAQ. So, and from a buffer standpoint, some might have, a 10% downside buffer. Some might have 30%, 50% downside buffer. So pretty big protections you can choose from. As a matter of fact, I'm not going to name the company, but one of them right now has where you can have a full downside protection with a pretty generous cap on the upside. And you don't have to be all in one strategy. While you may have one company you choose, within that, you can spread it out. Like, hey, I want some in small cap. I want some in S&P. I want some in the international caps. You could even have some in a fixed rate option. So you could do that. Some of them do have a fee, but maybe it's worth it. You'd have to explore that, whether that's true or not for you. So let's say one of them has 1% fee. Well, hopefully you're getting something for that 1% fee, such as maybe a multiplier, meaning, hey, I got money in the market, and whatever the market does, it's going to do a percentage better than the market. So that's something to consider. Some even have dual direction strategies, which just means market goes down a certain amount, you might actually get a positive credit. So that's dual direction. There's so much to get into here. I don't want to get too in the weeds, but one other thing I'll say that's kind of evolved in this space is you might have some of your money in a 5 or 6 year strategy, and then some of the money might be in a 1 year segment or a 3 year segment. And that just means, let's just say you were bearish about the market, maybe, going in, and you picked a 1 or 3 year segment. That just means you get a chance to reset at the end of the 1 year or the end of the 3 year. And so whether you get a positive credit or whatever, you'll be able to, quote, reallocate or resegment that portion of the account in there. So that's the RILA from a trend standpoint. What I've seen some people do is, let's just say you had money in a managed account, and in the managed account you had maybe a particular ticker that, or even a mutual fund that is mirroring the S&P, right? But it's inside of a managed account, so there's a fee associated with that. Could be, 1% or something like that. Could be an expense ratio as well with the ETF or the mutual fund, right? Probably not a big one, but a small one. So and let's just say this isn't a retirement account, right? So this is not in a non-qualified. This is in a retirement account, an IRA, something like that. I've seen some people pull money out of that IRA into maybe a RILA that's kind of doing, if you will, what the S&P is doing, tracking standpoint, but maybe it's in a no-fee RILA. One other thing I'll point out too is there are no dividends when you do a RILA, so you're not giving any dividend credit. So just keep that in mind.
Okay, what's an example of an annuity that has high fees?
Right. So people talk about fees with annuities, and anytime you're getting one, you need to know the fee structure. You absolutely should know it. So those traditional variable annuities, some people would say that they have a high fee structure, right? And so if you're paying a high fee, you want to make sure the benefit that you're getting is worth it. So to kind of break down on your traditional variable annuity, what are some of those fees? So you got mortality and expenses. That's like M&E. You also have sub-account fees. So in a variable annuity, your traditional one, you could have lots of different sub-accounts. You could have, which are more or less kind of like mutual funds. You may have a high growth strategy. You may have a bond sub-account. There's lots of choices there. And so you're in the market in a lot of ways And so there's fees with those sub-accounts. You may have an optional rider. Some people choose an income rider, or a death benefit rider. So having a 3% fee on a variable annuity is not uncommon. It certainly could be that. And so if you're comparing that to a managed account, that maybe has a managed investment account, there's going to be, I would think, differences there, right? So even though those may be on an investment account, there may be a management fee, right? You could be in low-cost ETFs, or you could be in individual stocks, which don't have high sub-account fees. So just something to keep that in mind. Again, I wouldn't say it means you're never doing, but you want to make sure whatever you're getting, that benefit, that feature you're looking for, you want to make sure it is worth the cost. With any of our shows, anytime we're talking about things like this, just do your own due diligence. Do not be afraid to ask questions. To me, it comes down to financial planning, right? So, if you are to have any annuity in your financial plan, well, which one do you need, right? And whatever that is, how does that fit into the rest of your plan, right? It's kind of like when we talked about long-term care, right? If somebody has a long-term care insurance policy, okay, well, then that may affect the rest of their plan. If somebody doesn't have one, well, then that may just affect how they do other parts of their planning with, savings and investing. So I like analogies. So for financial planning, let's treat it like golf. When you go golfing, or if you just watch the U.S. Open, you get 14 clubs to put in your bag, right? So when you're talking about a financial plan, you have different things that you want to have in your bag, right? And so when you're thinking about planning, it's really important that you have the right bags in your club before you go onto the course, or in this case, the retirement plan. Same thing, when you're on the course and you're about to take a shot, you have choices, right? You got those 14 clubs in your bag to use. And so is there a tree limb in your way? Is the green a certain way? That's going to affect how you take your shot. Are you going to do a high lob? Are you going to do a low bump and run? So same thing with financial planning. Things happen that maybe you can predict. There's also things that you maybe cannot predict. So it's really important with your plan that you've got the right clubs in your bag to be able to adjust to when things happen in the external market or external place that you couldn't avoid, right? It's really important that you have a really good financial plan. Same thing, sometimes things happen to you personally. You just got to be able to make some adjustments to your plan.
Okay. So then tell me about some common myths of annuities. I heard you lose your money when you die.
Well, that can be true. If you had a SPIA and you wanted to get the highest possible payment while you're alive, you said, hey, I don't need to worry about beneficiaries. I don't need to worry about anybody else. I just want to get the most money I can out of this SPIA, right? And so you give that insurance company $100,000, gives you a high payment. Let's say you live to be 100, you may have made a decent trade there, a good bet, right? You pass away, a year and a half later, the insurance company in that scenario keeps the money, right? But they do have what's called mortality credit, so it just means that, or risk pooling, it means the other people that are doing the SPIA kind of benefit from it. So what I've seen, though, more common is in that scenario, someone might go, well, you know what? I'd really like to get at least 10 years of payments back from that SPIA. And so in that case, what happens is, let's say, somebody passed away after 2 years, at least for the next 8 years, those payments would go to a beneficiary. So that's how that would work. There are so many myths that are out there. So another one, again, might be, they're really expensive. And again, if you looked at a RILA, a MYGA, or a FIA, those don't have an explicit fee coming out of those. But there is what I would call opportunity cost, right? So, for example, a MYGA, you're going to get that multi-year guaranteed annuity, right? Or a fixed annuity, some people would call it. You're going to get a fixed rate while you have that contract, whether it's 3 years, 5 years, 7 years, 10 years, however long it is. So I would like to kind of equate that to, if you put money in treasuries or something like that, that doesn't mean you never should do it. It just means once you have that, the opportunity for high growth isn't there. So what part of your plan is getting the high growth, right? So that would be opportunity. Same thing on the RILAs. While there's high growth opportunities there, if you can't stomach or can't afford the loss of principal, that may not have been the right move just to have an annuity that wasn't a high cost. So there are a lot of myths out there. So those would be a couple of them that come to mind.
Okay. So then what are some good questions that someone should ask before purchasing?
Yeah. So I think knowing what is the surrender schedule is really important. Meaning, yeah. So let's say, it's got a 7-year surrender schedule. Well, that's not short, right? That's fairly long. So you want to know that, because at the end of the day, you're losing some liquidity. When you put money into an annuity, for the most part, there are riders and things like that. And yeah, you want to know the cost, right? Just, what is it? That's another good one. You want to know the credit rating. This is going to an insurance company. There are some guarantees in place as an industry, but if I was to give you an example, if one was giving you income for life, right? In that scenario, you probably want to pick one that's got a pretty decent credit rating, so that promise that they're making to you on the income for life they're going to be able to make good on that promise.
Okay. Is it better to purchase an annuity with qualified money or from a brokerage account?
Yeah, that's a really good question. And so what I would say to that is, I think personally, when you're taking money that's from a 401k rollover or an IRA, and now you're purchasing an annuity, when you do it like that, you're not really changing the tax structure very much, right? You have, especially if it was, let's just say it was a pre-tax 401k or a traditional IRA, when you do it like that, taking qualified money and you're purchasing an annuity, the tax treatment really isn't any different. When all the money comes out, it's going to be taxable as kind of ordinary income. And then, you could do a Roth, right? So let's just say you had a Roth 401k or a Roth IRA, and that purchased the annuity. In that case, yeah, you could take the money out and it would be tax free. So I don't see a whole lot of that, but that might be something we see trending later. While we're on that topic too, what I want to point out is when you get to RMD age, required minimum distribution, right? So let's just say someone's, 73 or older right now, and they're experiencing this with the Secure Act. What someone could do is they could take money out of a SPIA, and they could get a pretty nice payout out of it, and that might be able to satisfy their RMDs across all their IRAs, because the IRS, when they're looking at your RMD calculation, they're not taking it out of each account. They look at all the IRAs as one, if you will. So now, to answer the question about non-qualified assets going into annuity, this is important. I've seen this happen where people have a non-qualified annuity, and as a matter of fact, we had a young client that had done it with another agent, I guess, if you will. And so the important thing to understand that is he was young, took cash from a bank, if you will, and purchased a fixed index annuity, which I don't think was probably the best choice in a non-qualified account at a young age. But anyways, with those is he can't, I guess the person had told him that he could take out 10% a year, free of charge. Well, that's what the insurance company is saying, and that's true from the insurance company. But from an IRS standpoint, they're gonna have there's gonna be a penalty, 10% penalty on taking money out of annuity before the age of 59 and a half. So you really want to think about, do you want to do that? Now, somebody's just a high trader and they wanted to trade inside of a non-qualified annuity for a bunch of years and not have taxable events happening. You do get tax deferred growth on those. So that part's true. And then when you start to take the money out, after age 59 and a half, what's going to happen is it's going to be taxed as, the ordinary gains. And so that may be at a higher rate. Just like I've seen an older person after the fact, they'd had cash and then now it's inside of this. And unfortunately, you can't take it, out of an investment account. You could take out capital gains at a capital gains tax rate. And so once you take money out of here, it's going to be kind of ordinary gains. And so you could be taxed at a higher rate. So just got to be careful, make sure it's doing what you want to do. Me personally, I've seen them use more inside of qualified money than non-qualified money.
How does it compare to some buffered ETFs inside of an investment account?
So buffered ETFs is kind of a Wall Street's answer to, the SPIAs and even the RILAs. And so they're very similar. But let's say you had an investment account, you had a buffered ETF, which means you have some downside protection, right? And you're gonna have a cap, right? And the caps change. But you might have a buffered ETF that every year that cap can change, right? But it also resets based upon, the downside buffer that's in place. So they're very similar, but inside of an investment account, you might be able to, going back to the annuity part, if you had it in a non-qualified account, you don't have to worry about the 59.5, right? If it's not inside an annuity shell, if you will. So they do act similar, and they may be more liquid, right? You might be able to get it out without a surrender fee. So there are some similarities there. One's not necessarily better than the other. It's just important that it fits inside your plan. I think we're about run out of time today for Annuity Awareness Month. Hopefully this was helpful. We're going to have some future episodes where we're going to get into lots of different things about Roths. We're also going to have an episode where we cover private investments, some other alternative investments. Those are things I see just as a trend. And so I think it's important to kind of educate on that. You know what I mean?
Yes, and I just want to remind our audience, our listeners, if you have any questions, send them in because Ray will answer your questions on the show.
Yes, please do. Email any questions to Ray at sewealthpartners.com. Thank you for listening. Please like, share, subscribe, and we'll see you next time.
Thank you. Bye.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.